Well, good afternoon, brothers. Hope everyone is doing well and staying safe. Thank you for joining our second financial wellness program for this year. My name is Brother Marquis Macon. I have the pleasure of serving as Beta Nu Lambda's financial secretary for the chapter. Very excited to bring this series to you this year. Had a very good session. Thank you to those that joined our January session on breaking the tax code. Special thanks to Brother Terrence Hawkins for leading that, as well as Brother Chris Carter as well. So very excited for another great session for you this afternoon. The topic is going to be investing the almighty black dollar. So we're going to provide you with some tips for getting into the stock market, deciding when and where to invest in the stock market, and hit a little bit of some cryptocurrency basics. We have two fantastic brothers that are experts in this field that are going to present to you today, Brother David Neely, also Brother Carl Smith. So with that, welcome again, and I'll turn it over. I think Brother Neely is going to kick us off.
Thank you, Brother Macon. Thank you, Brother Macon. How y'all doing? I am going to cover the conversation today from a 30,000-foot view and talk about your overall portfolio. Your overall portfolio is going to include a lot of things, including the assets you invest. So go ahead and share my screen there on the planning and consulting process. And what I'm sharing with you today is my thoughts on how to manage your overall portfolio, especially if you're going to engage someone like me, a financial planner. The first thing you're going to do is have a meeting to talk about who you are and what your goals are. Even when it comes to investments, you want to have a goal. I approach my relationships with my clients from a behavioral finance point of view, meaning I want to know why they receive money the way they do. It helps later on in our conversations to help them stick to the strategies that we come up with. So you'll see the bulk of the process, steps 1, 2, 3, and 4, is talking about what they want, trying to understand how they move through the process. So that is my first recommendation. Have a conversation with yourself, and if you're going to engage a professional, about who you are in regard to money. So that's number one. The next thing I do is I sit down with my clients and I ask them to review with me a timeline of what they want. You'll see here I have on this graph a projection of your life. On the far left side, you'll see this is when you're born, whatever year you're born. I'm born in 1970. To the far right, you're going to glory, and I project that to be 100 years. So over 100 years of life, what do you want to see happen? In the middle, of course, is your midlife when you're about 50 years old. So when you approach a financial planner, let's just say you're 40 years old and that's where you are today. Between 40 and 67 is 27 years of focused investment in the way you protect yourself, in the way you manage your assets, decrease your liabilities, and increase your overall net worth. Isn't a whole lot of time when you consider how much life you have to live. You got to strike while the iron is hot. So I talk to my clients about how much money they want it to come in passively when they turn 67 years old. Someone tells me they want $10,000, maybe $100,000 a year coming in at retirement. We look over 3 categories, and these categories will come up again shortly. 3 categories of where they can invest their money. They can invest in tax deferred category. That's going to be like a 401k, 401a, or 403b, depending on where you work. Then you're going to have taxable categories. This is where you might invest in a brokerage account, your TD Ameritrades, that kind of thing. And you're going to have tax advantaged assets also. You may invest in your Roth inside your 401k or have an individual Roth IRA, municipal bonds. Your healthcare savings account is a great place for that. And also permanent life insurance is a great tax advantage opportunity where people can save money and protect their lives at the same time. These tax brackets will come into play here on my next screen. Just imagine, though, that if you, in this tax deferred category, You put all your money in this category. When you pull it out, it's going to be taxed at whatever prevailing tax rate, their federal tax rate there is at the time. If you want $100,000 coming in a year at retirement, and that's your gross that you generate, it's going to be taxed at the prevailing tax rate, 24%. So you'll net, after state taxes also, you'll net whatever's left over. So my goal as a financial planner is to see this number, whatever number you tell me here, and to work to minimize your tax exposure in the future. Not so much today. When I, there are, okay, I messed that slide up. Let me see if I can get to it here. So let's look at this. In these three different categories, tax deferred, tax advantaged, or tax free, and taxable categories, what I encourage my clients to do is to put money into each of these categories. I am pro 401k. Put your money into a 401k or a traditional IRA. I have no issue with that. I may change my recommendations on where you invest your money in the market, depending what your goals are. But generally speaking, I am pro tax deferred asset allocations. I'm also pro taxable allocations. Now, this 15% capital gains tax, it could be as much as 20%, depending on your level, on your income level. But for most folks, 15% capital gains taxes, this is when you have an investment and you hold that investment for more than a year. When you pull that money out, you'll be taxed around 15%. So when you hold the money, for instance, in a brokerage account and you realize the gain, or your real estate and you realize the gain, you'll be taxed around 15%. When you have your money into your Roth 401k or your cash value life insurance, and you pull that money out, you're not taxed on that at all. You have the strategy to pull your money out where you're not taxed at all. Combining these three asset allocations, 24, 15, and 0%, you get an effective tax rate of 13%. Now, the goal is to get here or less. There are some people who are totally comfortable with putting all their money here in this tax-free or tax advantage category. Other folks are more comfortable putting into the taxable category. And I would say most people put their money into the tax deferred category because they focus on their 401ks. But speaking with the planner, and Brother Smith is going to get into this a little bit in a few moments here, you can diversify and put more of your money securely, more confidently into this taxable account area. When it comes to your overall portfolio, I look at 4 areas in your life. I look at how much you make and then what's left over for you to save. If you can save money, you can get a planner or you can invest, either way. But your cash flow is king. This is the foundation to your house. Without cash flow management, you're dead in the water. This looks like reducing your exposures from subscriptions, maybe eating your lunch, taking your lunch to work, that kind of thing. But save money. After your ability to save money, I think protecting yourself, your life, your ability to work, your assets, protecting even your behaviors, we'll call it accident insurance, in your car is the next most important thing. I also think closing the back door on your portfolio with incapacity and estate planning is very important. Incapacity planning is important, in my opinion, because the way healthcare is set up now, even if you have a bad accident, you will probably live. And you may agree with me that it's more costly to live than it is to die. And you need to coordinate whoever's going to help you live and recover. And so that means you'll need to speak to a family law attorney, and you'll need to have in place a HIPAA waiver, a healthcare directive, different types of powers of attorney, whether they be springing or durable. You need to have those things in place too. This is part of your portfolio. Liability reduction. This is your debts. This is how much money that you have on loans, on your business interest, how much you've pulled out for retirement, those sort of things. And then you'll also need to manage your assets. And that's where someone like Brother Smith comes in. And we talk about the relationships between someone like me and your accountant, like Brother Hawkins, Brother Carter, and people like Carl Smith, who, if you want to invest on your own, can help you with that. So with that said, if there are any questions, I'll answer. But that is my point of view when we talking about what your portfolio looks like and what you should focus on. Brother Macon.
So good job, Brother Neely. Thank you so much. If I don't see any questions coming through, so we might be able to just jump ahead and adjust as we need, right? So good afternoon, everyone. My name is Brother Carl A. Smith, and I am the managing principal for Carl A. Smith Holdings, LLC, based out of Atlanta, Georgia. So today we're going to talk about building upon your financial plan, as Brother Neely just conversed about. Having a very solid overall comprehensive plan is key. Now, where I come in as a financial consultant is I come down from that 30,000 foot to really step in to be a little bit more tactical in regards to implementation, looking to somewhat move in and out of assets over comprehensive plan. So as we go through, if there's any questions, please don't hesitate to ask, and we can keep this as informal as possible and try to convey as much information as we can. So today I have really just 3 short learning objectives, right? So first and foremost is to decrease your fears surrounding the overall financial markets. What I find with my clients is they don't know what questions to even ask to begin to look for a financial advisor or really understand how the market works in general. And we'll talk about some of those things to try to demystify the terminology at a high level. So we'll talk about price, we'll talk about volume, overall market trends, and then how to do some high level technical analysis. And then we want to provide an introductory understanding. So understanding the full stock market is not going to be mastered in just the short period of time that we have with each other today. So we want to talk about some of the characteristics of the market and asset ownership. Again, really high level. And then how to build an investment strategy and kind of an investment trading plan that you can work with your advisor on to ensure that you are moving with the correct risk, as well as looking at your overall portfolio of assets and investments in general. So before we dive in, I want to piggyback on what Brother David Neely was conversing about, is having a solid plan to move forward will ensure that you have solid, consistent success. And as part of that overall plan, you need to start with what I call is your why, right? What is the reasons why you're investing? What are the reasons why you're looking to add a complement to your overall portfolio and focusing in on your individual money? One of the mantras that I have in my company is it's your money and it should be under your control. And the biggest aspect of your why is really understanding that money is a tool, right? Now, we see a lot of things on television and in the movies, people, not really holding on to their money and investing or just spending it inappropriately. And that's really where I want to start off today, is with a little bit of data. Very intellectual crowd, various understanding of the overall market. But let me take a few steps back and talk about money just in general, right? So just a few slides to kind of help ground us as we move forward to be a little bit more detailed. So we'll talk about spending. And over the last few years, we have really seen a significant increase in the overall spending of not only just certain communities, but then overall within the United States. So there is a center out of the University of Georgia back in 2018. They put together a multicultural economic report. And this report is published every few years. and it speaks about the economic advancement of all demographics within the United States. So in the 2018 report, I'll highlight just a few of those aspects here. I won't read through every line item on the side, but as you can see, there has been a significant increase in overall spending and buying power across the United States, roughly just short of $15 trillion in 2018. And as we look to 2021, that number has significantly increased. But really where I want to dig into this slide is both not only on the African-American side on the lower left hand, but also Hispanic side, and how much buying power and how much spending certain communities that are typically underrepresented in the financial system are really kind of the backbone of that financial system. And certainly we're seeing that over the last 12 months, 6 months from an African-American perspective. So from an African-American perspective, the buying power is roughly $1.3 trillion, which is a significant increase in just short of a few years, going from 961 billion to 1.3 trillion. And very similarly, on the Hispanic side, it's $1.5 trillion. So it's a significant amount of money that is not necessarily being invested back into our own individual communities, number one, but then also transparently into our own savings account, and then certainly into our overall investments. And you can see that in this next slide, where we talk about the median value of investments overall, irrespective of demographics. Again, this is coming from our last census data. We should see some updated data as the census has been completed and information is being tallied. But what I want to call out is three main areas: stocks and mutual funds towards the top, and then overall net worth with your home and overall net worth without your home. Now, many of us are very, very familiar with purchasing a home and understanding how you purchase at, say, 150,000, and 10 years later, or whatever time frame later, you sell it at 200,000. But as you can see, these numbers are significantly skewed away from African Americans and Hispanics, and even Asians to some extent, in correlation to our counterparts. So the aspect that kind of stood out to me is in the second subsection, net worth with a home, where African American net worth was roughly $12,000 with a home. Now that's across all respondents to the US Census. Now correlate that to white Americans with a net worth of 110,000, and then Asian Americans coming in with the highest at 156,000. Now those that are listening to us today may not look at this as new information, but this is something that really should kind of make you feel a little bit emotional on why we are not advancing as a collective group of people, given the amount of spending and buying power that we have denoted on the previous slide. So for me, and the driver of why I started my company and why I continue to speak publicly about this, is it's all about creating generational wealth, irrespective of your demographic, your background, your overall history from a family perspective. I know for me, finance and just overall money was not something that was talked about every evening or even once a year at the dinner table. So I want to take it as an opportunity to put a stake in the ground today for all of us to be able to move forward, to collectively understand how the financial markets really, really work. Now, again, this is going to be a high-level primer to get you started and, quite frankly, get you into the game and be able to work with your financial advisor, very similar to Brother Neely, to ask better questions. So if you understand some financial basic information, your advisor can now talk to you on those first few conversations at a higher level because you understand the basics. I'm going to give you a little bit of those today as we move forward. Okay? So first and foremost, in understanding the financial markets is obtaining knowledge of really how the market works. And we'll talk about that. So first and foremost, I want to kind of give you the nitty gritty, the real, if you will, that the stock market or any market that has two-way interaction between buyers and sellers, and in the stock market perspective, it's called bulls and bears. It's an overall auction. And there's certain capabilities of an auction that we'll dig into as we move forward. But high level, the market is fundamentally an auction. So you may say, Brother Smith, well, what's an auction, right? Are you talking about something I might see on television or an art auction? That is exactly what I'm conversing about. So an auction is a sales event where potential buyers place competitive bids and sellers submit offers on assets or services. So you're probably very familiar with, say, an art auction or a car auction. Some of those individuals that are a part of real estate, you may have been part of a real estate auction, potentially in the courthouse steps. That is basically how the market works. You have a group of buyers, you have a group of sellers that are coming together to try to exchange goods and services, or in this case, stocks, and they're manipulating price to be able to lock in on what is fair on both sides. Now, this happens extremely fast throughout the market. And that's something that we'll talk about a little bit on the next slide of really how does that haggle, if you will, take place. So let's dig in a little bit, right? So grab your pen, grab your pencil, and let's really uncover a few of those hidden things that I kind of tend to share with some of my clients. So as I stated, the market is really an auction process. So we'll kind of walk through this slide from left to right. So you have buyers or the bulls, right? So on the average, the stock market goes up 98% of the time. Now you may say, well, hey, that doesn't sound correct. Just this past year, we've seen significant selling in the market. That remaining 2% is really where there's opportunity if you're into the market from a long haul. So buyers are looking to purchase assets that they feel are undervalued and looking for a fair price to buy and potentially sell later. Very similar for those that may have collected baseball cards or have collected cars themselves. You're looking to buy something that's undervalued with the opportunity to sell it some period into the future for higher than what you've paid for it. Now, prices are really only valid at a snapshot. And as you all know, the stock market moves very, very quickly, depending on what lens that you're using. But fundamentally, the buyers, they want to buy low and sell high, very classic. Now, conversely, the bears or the sellers, they've made their money if they've been in a position and they're looking to exit at a fair price. So the market has been on a tremendous run upward or bullish over the last 4 years or so. And if I extend that lens, it's been a pretty long run, roughly about 20 years of pretty consistent price increases. But every so often, the bears tend to have control of the auction, and then you see prices decreasing as they're looking to sell and lock in profit. Now, the buyers see this as an opportunity, if they're thinking longer term, to step in and purchase at discounted prices. Very similar if you go into your grocery store, if you're at Safeway or Kroger or Publix, whatever your fancy is, you don't necessarily look to pay full price on something that you know could be on sale sometime in the future. Now, these individuals go back and forth to submit competitive bids and competitive offers to try to maximize their position. Now, think of it as an arm wrestle back and forth that happens very, very rapidly. And fundamentally, that's the auction process. So how does that auction process fundamentally carry forward into the market? So let's dig in with a little bit of an example here. So on the left-hand side of the slide, we have Jamal, and on the right-hand side, we have Kalila. Both of those two individuals have a focus on, in this example, McDonald's with the ticker symbol MCD. So Jamal has 100 shares of McDonald's, right? He's been very successful and has accumulated a good amount of shares that he is looking to sell because he bought those shares at a lower price and he's looking to exit and take profit. So he is asking $64.14 per share. Now, conversely, on the other side, Kalila, who wants to buy shares, she is looking to pay $64 even. So you see there's a little delta between those particular prices. And as you see in the middle here, that is what we call the spread, what is a 14-cent spread. So they haven't locked in on an actual price. So this is where the auction process continues to move forward. So there's other individuals worldwide that are moving up and down, but these two individuals are locked in on their price to what they would like to pay and what they would like to sell for. Now, ultimately, they have some mutual agreement here at $64.01, and that's how shares are exchanged. Now, this sounds very simplistic because it really is. It's not overtly difficult. Now, most people don't understand this simple exchange and negotiation. Now, this happens millions and millions of times a day, and some of it is very, very rapid, and some of it is very, very extreme, albeit upward or downward. Now, there is no guarantee that the asking price that Jamal had was going to be accepted by Kalila or some virtual person. Now, that's where the beauty of the market comes in, because Kalila might have the opportunity to purchase the shares at $58, at $59, depending upon how the auction process moves upwards or downwards over time. Now, again, this happens very rapidly. We can kind of give you a little bit of a visual representation, and we'll dig in a little bit more as we move forward in subsequent slides. But fundamentally, this is how the auction process, and then macro, this is how the stock market works. And it goes upward and downward, okay? So as we stated, the overall broader market, and what I have in front of you to share this afternoon, is a 20-year visual representation of the S&P 500. So the S&P 500, you probably hear this quoted on the news or on your radio stations, or if you're old like me, you remember looking at it in the newspapers way back in black and white days, so to speak. So as you can see, the trend or the angle of ascent is upward over the last 20 years. So if you look back from March 2001 to just this past month, the S&P 500 has grown 244%. That's a significant growth in just a short period of time. So I'll pause real quick. I've conveyed a lot of information. Let's open it up for some questions and see if we can answer those as directly. If Brother Macon, if you could help us out with a couple of the questions, that's great. So I see a question that says, can you speak more about the incapacity planning? And then the second question is, could I take some of my 401k and purchase stocks? I'll take the second one. Certainly you can. Now, there is an aspect of your overall portfolio that you would need to work with your respective corporation to see if you have the ability to have what they call as a self-managed 401k. Certain firms and certain plans allow that, certain plans do not. That's something that you can speak with your HR or your plan administrator. Like, for example, in my company, we leverage Fidelity as our broker for our 401k, and they do have a capability to allocate a portion of your 401k to be self-managed. Okay. And Brother Neela, did you want to add anything to that?
Yeah, on the 401k side, there are certainly restrictions on and different triggers on which you are eligible to pull money out of your 401k without penalty. Of course, once you hit 59 and a half years old, you can pull the money out. But since it is in the tax deferred category, any money you pull out of your 401k is going to be taxed. There are strategies. If you pull the money out in the form of a loan instead of a withdrawal, where you won't be taxed on it, then there are also time requirements for which you have to pay that money back. So there's that. How that fits into your overall goals is something, if you're working with a planner, you can talk about. Of course, if you have that same money in your cash value life insurance policy, the game does change. So there's that. There was a question about incapacity planning, and I because I'm not an attorney, this is some information I got from one of our fraternity brothers, as a matter of fact, Jackson Williford. he and I work together a good bit, and he is going to be rejoining us as a dues paying member here soon. Brother Macon, you'll be getting a note from me later on today about him. But anyway, so what Jackson explained to me is that incapacity planning involves documents like a healthcare power of attorney. This is a document that says who has the right to say what you want done if you can't communicate. Sometimes the healthcare power of attorney is folded into a healthcare directive, but again, it does give the holder of that power of attorney the right to make decisions about your healthcare. That that document can be either durable or springing. The difference is a durable power of attorney is effective the moment it is witnessed and notarized. From that moment, whatever you can legally do, you have now cloned yourself. If you can sell your car, for instance, you get someone a general power of attorney. If you can sell your car, if it's durable, the moment you give that document to the holder, that person can sell your car too. In the springing version of the power of attorney, the power of attorney does not become effective until a certain event or events occur. So if you can't, there may be language in that document that says, if I can't communicate, if I am, in an automobile accident, if I'm out of the country for a couple weeks, this power of attorney then does become effective and enforced. You may also, as part of your incapacity planning, have a HIPAA waiver. For instance, like a married couple, you may, if you have a relative or someone else that you trust that is a nurse practitioner or a doctor, you may give them the authority to also review your medical records. If my wife was in an automobile accident and couldn't communicate with us and the doctor was speaking Latin to me, I could bring her sister in, who is a nurse practitioner, with full authority to see Shauna's medical records and help me make decisions, right, as her husband. Because you can be talking to me anyway. It's a sister. So the other side of this is you have bank account signatories where someone has access to your bank accounts to spend your money. I had a young lady I used to teach Sunday school. Her mother got ill and was diagnosed with a terminal illness and could not communicate. But because Carla didn't have a healthcare power of attorney or even a general power of attorney, the bank would not allow her access to spend the mom's money. The money was available, but she couldn't spend the money. Also, the mortgage company would not talk to her about the status of the mortgage because she didn't have the authority to do so without that general power of attorney. In short, mom passed away, and they were not able to pay the mortgage because they couldn't access the bank account, and the mortgage company would not negotiate anything for the mom with the daughter. And so they couldn't do anything with the mortgage or anything until mom passed away. But with a few documents, that situation can be avoided.
Thanks for that, Brother Neely. Feel free to continue to send your questions or comments into the chat box. We'll continue to monitor those. All right, and I don't think there are any more questions. If not, we'll jump right in. Brother Smith, ready to pick up where you left off?
Yeah, certainly. Thank you, Brother Macon. So as I stated, the S&P 500 is probably the number one asset that I recommend to my clients. It's really difficult to pick individual stocks to invest in if you're unfamiliar with how to search and how to really quantify one company over the other. So it's kind of the old school mindset of kind of set it and forget it, if you will. George Foreman style is, if you want to invest into the market, buy the market, because the majority of the mutual funds in the United States are benchmarked against the S&P 500, right? So if you're unfamiliar and you want to invest, this is where I would recommend that you start. And then as you begin to get more confidence in having good conversations, say with Brother Neely or whomever you trust to give you advisement and consultation, that's where you can move forward. But as you can see, 20 years of S&P 500, just from a price increase perspective, it's been 244%, right? Which is ridiculous in regards to the amount of return in a relatively short period of time. So what you have in front of you is what we call a candlestick chart. And we're going to dig in a little bit more to understand. So when you do leverage your platforms, albeit if it's TD Ameritrade or E-Trade, Schwab, any of your bigger brokerage companies will have some of the capabilities that I'm going to recommend. Probably the number 2 question that I receive with my clients is, well, what company should I leverage as my broker? Fundamentally, it doesn't matter. However, I would highly encourage individuals not to use a Webull, a Robinhood, and certainly not Cash App to buy stocks. And we can talk about that later on in the session. But if you stick with some of your larger brokerage firms, you'll have a lot more capabilities and, quite frankly, some very solid customer service. So let's step into to really understand kind of how you read charts, right? So as we stated earlier, you have bulls and you have bears, and they haggle back and forth. That haggling is called the auction process, and price moves up and price moves down. And as you saw in the previous slide, we spoke about, well, how can there be a visual representation of that price movement over time? And typically, individuals use candlesticks as kind of 2 or 3 other ways to map out that overall price movement. But we'll talk a little bit more about candlesticks. So we'll start here on the left-hand side, if you will, if you can kind of follow the mouse, where you have the bulls. Now, each and every day and each and every minute, quite frankly, there is a new candle that is created to map out price movement. I don't recommend any of my clients look at a time frame of that price representation tracking less than 1 day, preferably on a weekly basis, if not on a monthly basis, because we don't want you in and out of your portfolio. You're in for the longer period of time. Now, for those that are looking to be a little bit more engaged or active, as I call it, active investing, you can begin to step down in time frames. But I typically don't recommend anyone moving forward with a less than a day time frame. Now, as you can see, both of these 2 candlesticks, the green for bulls and red for bears, are representing the same aspect, but just in reverse. So as the auction opens in price on a bullish day, you can see that the opening price here and your closing price is visually represented. You can kind of see these little tails or pigtails, as we call them, at the top. These are representative of the high price and then the low price, just on the opposite end of the scale, of price movement for that particular day. Conversely, on a bearish day, or when the sellers are more in control, the auction opens at the top of the candle and closes at the bottom of the candle, right? And then high price and low price. It's just a very visual representation to help you understand kind of how those mappings of price are visually represented. So we'll dig in just a little bit more as you can see various different charts, and we can pull that up later on this afternoon to kind of show some real-time examples. So I won't read through everything here. You can read the subtext here. As you see price movement from a bullish candle perspective, where you see kind of a fuller oval, if you will, to showcase this is more bullish, right? And moving forward, kind of left to right, second most bullish, as there hasn't been a lot of price movement within a range, and we've closed the auction toward the high end of the range of price. And then very similarly, as we converse to the right-hand side, you can see we begin to be a little bit less bullish given the visual representation of price. Now, success, in my opinion, in the market to some degree is what we call pattern recognition. If you can look at a chart and kind of analyze it relatively quickly, you can come up with a hypothesis. Is this a better time to purchase, or is this a better time to sell? Now, on the bearish side, it's the exact mirror image of the bullish side, as you would tend to believe. I won't go through all of these details here, but as you begin to look at these individual candles and then step forward and begin to put together day after day or week after week, you can identify what we call our trends. And trend analysis is, in my opinion, arguably the most important area of being profitable, because there's two sides. I'll take one step back. There's two sides of analysis when you're looking at a corporation, albeit if it's Apple, if it's Home Depot, if it's Kroger, if it's Ford, it really doesn't matter. And I didn't say this at the onset, the process of the analysis and the information I'm sharing now does not only just work on stocks, but it also works on foreign exchange and certainly cryptocurrencies. I'm not going to speak very specifically on Bitcoin or Ethereum, but they all have price representations by charts, and you can identify trends within those asset classes as well. So you have financial analysis, kind of your purchase and loss, your balance sheet, your quarterly report, annual report. And then you have technical analysis that can be done via visual representations of price movement. That's where my expertise lies. And I personally believe that is really where you can consistently be profitable, as earnings reports only come out 4 times a year, in some instances, maybe 5. So how do you determine if a company is worth the investment? You look at the charts to determine if you're in an uptrend where there's potential higher price movement, or if you're in a downtrend where there's typically lower price movement. So how do you identify an uptrend? So think about all of the information that you learned in middle school, high school, and to some extent in university, where you were trying to identify trends mathematically. How are you connecting lines to dominate a certain angle of ascent or descent? This is what you can carry forward into everyday life today. So an uptrend is identified by seeing higher high prices and higher low prices. You can kind of see that in the top graph on the right, where we have an uptrend where you're continuing to see higher prices as well as lower high prices. And that's important to identify an uptrend. You can kind of see what I call a Zorro pattern, where you see prices moving upward, they'll pull back slightly, and then continue on upward to its original direction. That's a classic definition of a very bullish uptrend. The opposite side is a downtrend, where you're seeing lower lows and lower highs. And a pattern that I've kind of coined is the Zorro pattern, right? So those that are very familiar with the old Western television show Zorro, he always would use a Z as his mark. You can kind of see that in these types of patterns, the ABC pattern, it kind of unfolds. And as you look at charts, you'll be able to see those, and that helps you identify the trend. And you never, and I mean never, want to go against the trend. That adage, the trend is your friend, is a classic one that can consistently be applied to not guarantee success, but increase the probability of your success when purchasing or even selling an asset. So we spoke about how price moves, but at the same time, let's dig into that a little bit more. So by definition, when it looks to the market, price is an advertising mechanism. And I say that how price is aligned to the market, but it's also a step forward to the auction process. Think about the paper that we receive the Friday after Thanksgiving that highlights kind of Black Friday sales at the mall or online. Price gets you to look at that ad and potentially physically go into the store or even purchase online. So it's an advertising mechanism. And we all know that those big screen TVs that you may see at Target, 4K for $84, they may even have one of those. So it's an advertising way to get you interested. And that's the same way in the stock market. Because price fluctuates, right? Price decreases to entice buyers to step back in to push it up higher. The bid price that you may see is the max price in the market to buy. Remember the example we showed earlier with Jamal and Kalila. Both were on opposite sides, and what they submitted for their orders was representative of what they wanted to do. So the bid price is what you are willing to pay for the max price, and the ask price is the minimum a seller is willing to accept. And again, the difference is a spread. So how do you determine what's a fair price and what's value? We'll speak about that in probably a subsequent session, not necessarily today. It's a little bit more detailed, but very easy to understand. One of the things that helps you determine how strong your trend is, how strong the buyers and or sellers are in their conviction to that trend, is what we call volume. And volume is defined as the number of shares, or if you want to look at cryptocurrencies, the amount of Bitcoins or the amount of Ethereum or the amount of orange juice that you may buy or oil. It doesn't matter. Volume is representative of the number of shares of the contracts traded in security or an entire market during a given period of time. So a given period of time is the snapshot of the auction process. If you recall, an auction can be every minute, every 5 minutes. Preferably, you're looking at it on a daily or even a weekly period to track visually. Now, the volume is the force, it's the momentum in a certain direction that shows conviction. You could think about it from an analogy perspective. As you get closer to the luau, as an example, the volume of tickets tends to increase on a daily basis, and even to some brothers on an hourly basis a few hours before the event. So that shows that there's a lot of conviction and there's a lot of energy and excitement to step forward and purchase those particular tickets to come to the venue. But volume is one of the most basic and important concepts to understand when trading, because volume is an indication of where the larger institutions are investing. And you always want to follow, never against, the biggest institutions. Some of this is very visible over the last few weeks or so, very high-flying stocks that typically weren't in play. GameStop is a classic example where there was so much volume, which caused price to increase and increase and increase. Some of that was institutions and some of that was retail traders such as you and I, but there was enough liquidity, but it was imbalanced to the bulls versus the bears. But there still was volume. Again, it's the force to showcase the advertising of a directional trend. So as you move forward in understanding volume and price, the last major aspect of understanding how you're looking at charts and being able to make a good decision on when to invest, to enter, or when to exit is understanding support and resistance. So fundamentally, a support level is a level where the price tends to find physical or visual support or a footing as that price decreases or falls. You could think of it as the floor that you're sitting on right now in your home or in your office, or if you're listening to us in another location. It's very solid, right? You can't really go through the floor. Now, conversely, resistance is just the opposite of a support level. It's where price tends to find resistance or a ceiling as it rises. So if you're on your first floor of your home today and you look straight up to the ceiling, that is resistance. But if you go to the second floor of your residence or wherever you are and look downward, that is support. So I say that as an example, as price continues to move upward through resistance and tends to stay there, you look backwards and you would see that that resistance line is now a support line. And you can see this much more visually here as we walk through this individual slide. So this is Facebook, a 1-year chart of Facebook where each candlestick is representative of 1 week of price action going all the way back to mid-2013. And I've called out a few support and resistance lines. So we'll take this one here, if you can see this on the chat, where price was ascending and hit a resistance level and price began to pull away from that. So that was clear resistance. However, price returned back to that level and was eventually able to break free from that. And then now that line turns into resistance. And then that cycle is continually repeated throughout the overall period of time for any individual chart. The more charts you tend to look at, you'll be able to visually identify support and resistance areas very, very quickly. And typically, Resistance areas are where the bulls typically would look to sell, and support areas are typically where the bulls would step in to buy, right? So bears looking at resistance for areas to sell, and conversely, the opposite side for looking to buy, right? So I'll pause real quick if there's any questions into the chat here, and we can.
All right. Can you guys hear me?
I can hear you. I guess I was on mute. I didn't know that was on mute for some reason. So there are a couple of questions I see in the chat. Do you want to kind of go through those, or?
Yeah, sure. Can you guys hear me okay?
Yes.
Yeah.
Okay, great. First question here. Why is Robinhood not recommended? He found it useful to learn as a beginner.
It is not recommended for a couple of facets. Some of them are very evident. Some of them are a little hidden as you get deeper and deeper into the industry. First and foremost, the very visible piece, it's their customer service is horrible. Not only just in the last few weeks, given a lot of more volatility into the market, but several times throughout calendar year 20, as well as in 21, individuals were not able to access their funds in Robinhood. Not necessarily because they were invested in a specific asset. The entire platform was down for multiple days. So that's point number one. Point number two, remember when I said earlier, you have buyers and sellers, and then both of those individuals are willing to pay a certain price. But the delta or the difference of those two prices is called a spread. The wider the spread, the worse it is for you as a buyer and seller, and more beneficial to the brokerage company. So I challenge you, look at a bid-ask spread on Robinhood, and then look at the same asset on E-Trade or Schwab. That bid-ask price will be smaller because it has greater liquidity. That brokerage firm is much, much larger. Is it a great platform to start to learn? Yeah, 60-40, yes, but I would not leverage that as my main investment portfolio, even if you want to be an active investor. Go with a larger organization. Robinhood was great because it was a disruptor, because they typically had zero commissions for stock purchases. Now every broker has the same thing. So there's no huge competitive advantage to leveraging Robinhood or Webull, but certainly not Cash App. I can't tell you how many people text me and say, I bought something on Cash App and I really want to just hang up on them. It's not the right thing to do, right?
Great.
Yeah, I don't have much more to add to that. I totally agree with that. Fractional investing just isn't going to make you a lot of money. It just doesn't really get you. It doesn't really build your asset base very much at all.
Mm-hmm. And if you're a beginner, you can be a beginner at E-Trade. You can be a beginner at Schwab, who just purchased TD Ameritrade about a year ago. So if you're in Robinhood, stay if you feel comfortable, but I would highly encourage you to move your money, right, to a larger firm.
Thanks, brothers. We've got another question here in the chat. Can you speak on the common statement, time in the market is better than timing the market?
Yeah, there's a concept called sequence of returns, and sequence of returns speaks to the unpredictability that your money will be there when you want it to be there. The longer you are in the market, the more likelihood the money will be there. But if you, because the market is so unpredictable, you don't know what force is. If people are going to be getting on Reddit and driving up the price, and then it's going to meet some sudden resistance, Robinhood's going to go dark and the price is going to fall. If you're trying to time that, you may time it wrong. You may have to go to work. You may be asleep when it happens. And if you're depending on that money to be there when you want it to be, then you have to stay on it all the time. This is why a lot of day traders back in the early 2000s were jumping out of windows. They were trying to time the market and they missed. They missed badly. And so it was just, for peace of mind and the level of risk that most people want to take, time in the market is trying to find a specific place to get in and out of the market just doesn't work. I'm a big believer in diversification.
Mm-hmm. I'll concur that there's advantages to both, right? In my opinion, because, there's a lot of companies that had been bellwethers, right? Meaning very solid companies that individuals had invested in for the long haul that are now going bankrupt. Hertz is a classic one. JCPenney's, Macy's, Enron is even more of a classic one. So can you time the market? To some degree, yes, but probably 99% of the time, no. However, you can set as part of your plan entry targets where you are making a certain amount of money or you see a certain percentage increase and you don't feel you want to invest in this company in the long haul, take your money out, right? So I work with my clients that state, hey, before you get into any type of investment, always look at your exit. Your exit is actually more important than your entry because you've identified, hey, I'm going to get off this train. I've made a certain amount of profit. Now, we can dig into that a little bit more in a subsequent session, but I would not look to do any type of investment unless you're getting at a minimum a 2-to-1 risk reward ratio, meaning, hey, I bet 1 to make 2. And that's what we call a positive trader's equation or a positive investor's equation. You can think about, well, you can't time the real estate market, so why would you think that you can time the stock market, right? It doesn't work like that. And cryptocurrencies work the exact same way. You can't really time it, but at the same time, you can certainly set in specific profit targets. Right? There's a question, is cryptocurrency worth the investment? It depends upon what crypto that you're looking to invest in. Personally, I don't recommend any kind of smaller cryptocurrencies. I would stick with the two biggest ones, in my opinion, Bitcoin and Ethereum. I wouldn't try to chase some of these little bit more random ones until they have a little bit more solid fitting. Now, there's some aspects of cryptocurrency that is beneficial, but I've seen many, many individuals just lose their shirt because they don't understand what they're getting themselves into. And they're purchasing very randomly in very illiquid cryptocurrencies, right? So I see somebody speaking about Dogecoin. I wouldn't put my money into it, but I can't tell you not to do that. I say do your research, and if you trust yourself. But anything that has become so visible as of late is probably not going to have that institutional backing. But I do know institutions are now stepping forward and looking at Bitcoin and Ethereum. So I'd curve you to probably those two. But it is the wave of the future, right? So I know we've been conversing for a little while. Just have a few more slides as a wrap up, and then we can really open it up. So just a couple of takeaways. Again, the intent today was just give you a high level primer, kind of talking about some of the key takeaways on why you need to invest into the market, right? Now we can talk about the mechanics, but the why is really going to help you stay into it. As I stated in the last bullet there, it's 80% psychological and 20% mechanical. But there's a number of individuals that I come in contact with that really, kind of put up the Heisman, if you will, to the stock market. No, I'm not. That's too risky. I don't want to lose money. Well, who wants to lose money, right? That's not the goal of any investment, is to lose money. But you will lose money at some point, right? Not every house that you've purchased has appreciated. Not every car that you purchased has been a very solid car. So there's risks in everything. The goal here is to, number one, don't be afraid, go investigate, follow someone that you trust, and then come up with your own plan. But more importantly, kind of look at things from a calculated risk perspective, right? We take risks in our everyday life that we don't necessarily think about. I know many of us have driven without your seatbelt, or you have maybe driven home when you had one too many, right? There's risks that we take, but they're calculated risks. As both myself and Brother Neely articulated, is that create and use an investment plan. If you don't have a great plan, you're going to activate very willy-nilly, or even worse, you're going to follow some recommendations from your barber or someone that you meet on your street that has no understanding of the market, and they're following something that they read on a forum. So take advantage of the information and the people around you to help you put together that plan. Every client of mine, I tell them you should have an advisor. And if you don't, I can recommend a good half dozen that I trust as well. Again, your order exit is more important than your order entry. I've seen a number of people. I have a client right now that had a significant increase in their portfolio on one trade, upwards of 7 figures, and he's not exiting the transaction. So there's a lot of risk associated. So he didn't think ahead of his order exit. So many individuals I see in the last month or so that are chasing stocks, right? Chasing GameStop, chasing Nokia, chasing Ford. You can't hit a home run like that. I recommend you get a good watch list of roughly about 25 companies, various different prices, and then invest into those. Don't try to hit a home run, and that's gambling. You're better off going to Vegas than doing that. I recommend you look at a stock that's over $25 a share, right? I don't recommend you look at anything less than that. Primarily, even maybe 25 at the lowest, like $10, because institutions don't invest into companies that are typically less than 10 and typically less than 25. And volume should be over 1 million shares on a daily. That shows that there's two-way price action, because for every buyer, there's a seller, and for every seller, there's a buyer. Look for trends, support, and resistance. And then most importantly, I think that the aspect of what we're doing today is to obtain additional information and education, right? So it's financial literacy and financial understanding, but it's 80% psychological, as with anything, right? You think about those that went through a rigorous process in undergrad. It was psychological, right? Some physical, but it was psychological. It works the same way into the market. It's 80% psychological and 20% mechanical. And if you stay mechanical, these small incremental habits over time will change your trajectory to ensure that you have some pretty good success. So I'll open it up for some questions. Great questions coming through the chat. Please keep them coming. Someone asked, should I invest in Dogecoin? No, I wouldn't. Sorry to be direct, but I wouldn't. TD Ameritrade is a great platform for beginners to learn and invest in the stock market. I would concur 100%. And most of your larger brokerage institutions, they give away free training. They give away free workshops and webcasts. There's no reason not to be informed about the stock market. I was reading an article in the Wall Street Journal about 2 weeks ago that said 1 in 5 people in the US is actively investing in the stock market in 2020 that was not active in 2019. So it's something that has become very visible, but at the same time, it's ruining a lot of people's lives, as Brother Neely alliterated earlier. So my ask is that you take the time to learn. You can ask us any question. I'm sure we'll give it to you as straight, without a chaser, so to speak, as possible, because we want you to be informed and successful, right? But most importantly, be able to have it repeatable, right? That's the key, is success over time. So if anyone wants to reach out to me, I'm really not that handsome in person. So those that do know me, please don't hesitate to reach out. And thank you for the opportunity to converse with you this afternoon.
All right, excellent. Thank you, Brother Carl Smith and Brothers David Neely, for this awesome presentation. Hopefully the brothers on the call have taken lots of good notes. I know I have. And so, again, thank you to the presenters. Thanks to those that have joined. We will be same place, same time next month, March 20th. Our next session is going to be titled Financial Freedom, Our Only Hope. So we'll talk more about optimizing your credit and reducing your debt. So excited to have some great speakers coming up for that session. With that, we'll go ahead and end for today. Thanks again for joining, and have a good rest of the afternoon.